It's been a hell of a ride up. And congratulations. You are literally sitting at the top of the world right now, which represents the highest point the markets have ever been. But you got to now manage the expectations of what's next. I don't care how you do it, just be the bank. If you do it from your HELOC, your 401k, your whole life, your bank accounts, just take money out, but redeploy that money back to the original source. I'm just trying to get you to start thinking about what's really going on out there and why things are the way they are. Welcome back, everybody. Another week, another wealth webinar, and I am so excited because today we are talking retirement. That's right, that word, that fake word that we've been taught to believe is the magic day at which we stop working and sail off into the sunset. How's that working out for everybody? Do we have any retired folks on here? Put retired in the chat. Just trying to kind of take count. And I just want to make sure that everybody that puts retired in there fits the bill for what we've been taught retirement is. That magic day where we punch the clock for the last time, where we have that big retirement party in the office and everybody pats us on the back, on the butt and says, all right, and now your life can begin. And what happens? Can anyone tell me? What happens when that day happens that you retire? You go broke? Linus says nothing. Let's see, limited spending. So you go to a limited spending, fixed spending. Perfect word, boredom. And I love it. Will just came in and said, you get another job. You enjoy life, right? You have more kids. Did somebody just say you have more kids? Let's see. You have more kids. Yeah, Derek did. Derek, man, you're doing something right. If you're having kids at 60, 65, kudos to you, man. Send us the secret. Put out your new webinar teaching us all how to have kids after we retire. So the whole point I'm trying to make about retirement is that it's not all that it's cut out to be. It can be, but it really shouldn't be the day where you stop. Because if that's what your retirement is, I can tell you the statistics behind that. The day you stop working, you lose purpose. You don't have a drive. What are you really working for? You're just relaxing. You're just trying to kind of make up for all the stuff you didn't do, live out the bucket list. And you know, so many people want to live their bucket list and do all those things they dreamed of doing during their working years, but they couldn't because they had kids. Got to do the 9 to 5, got to be at work, got to put in overtime. Oh my God, boss is telling me I can't do this. So we try to get it all in then, but it, you know, I don't know, it's 60, 65. I mean, come on, listen, like my knees aren't going to be working as well at 65. I'm not going to want to go hit 60-foot tables. I'm not going to want to do all the things that I could have done in my younger years at that point. I mean, only one person on here is probably making babies after 60, 65. So, I mean, like, what do? You go golfing and you relax. But it really all leads to the same thing, and that is boredom, lack of purpose. And the statistics show most people die. How many times have you heard the story of someone retiring and then literally within 5 years, they're gone, they're no longer with us? And that really has a lot to do with just really what we're here on earth to, for. We're not here on earth to live without purpose. We're here on earth to live for purpose. We're here on earth to serve others. We're here on earth to change things, to change ourselves, to evolve. And you don't do that when you just stop. So I at first wanted to say we are going to talk about retirement, but we're going to talk about retirement as the time where you control your time. That is going to be my definition to you of retirement. It is that point in time where you get to control your time. You can get to say, I'm doing this or that. No one else controls your clock except you. That, to me, is retirement. I think it should have a different name, but we'll just leave that for another day. But for you to be able to control your time, we do have to get ready for that. We have to plan for that. And we can use some of the traditional things that have been taught to us and given to us and told to us, like 401ks and IRAs or self-directed IRAs, simplified employee pension plans. I mean, all these retirement accounts, because really that's all these are. These are literally retirement accounts. And along with that magic word, retirement accounts, comes a couple things. And let me tell you what they are. A magic age. Literally, somebody is telling us when we can enjoy this. And it isn't going to be until after 59 and a half. So we are told 59.5. And at that time, when we retire, any of these that are not Roth, that is the time where when we take money, we have to pay the tax man. So distributions are taxed. And if we take money out too soon, if we retire too early and before 59.5, we face a 10% IRS penalty. So like, these are the things we just have to be aware of. So if we're using traditional sources of money, we have to understand the rules of engagement. 59.5, you're going to pay taxes on the money when you take it out. If you take it out too early, you're going to, penalty, if I can spell, okay, penalty of 10%. Those are some of the things you actually need to understand. And the other thing you need to understand is just because you save a bunch of money in these accounts doesn't mean that's going to last till the day you die. And this is something that happens to a lot of people. They run out of money before they run out of life, before they run out of time. And that's a great problem to have. I just want to let you know that. I mean, it's bad on one side because you got no money left, but it's good on another side. Hey, you beat the statistics. Like they said you were going to be dead at 88 and you're now 92. Congratulations. And congratulations now because you got no money. You got, good chance you don't have any children that are around you anymore. Like now you got to figure things out. You can't go to work at 90 or 92. I mean, that'd be tough. So where's income going to come from? Well, these are the problems we face today. So in today's training, I want to hit several different points. I want to talk about retirement, but I want to talk about retirement in terms of today. I want to talk about your retirement account. I want to talk about whether you're doing things the right way or the wrong way based on your needs and goals. I also want to make sure that we talk about how to minimize risks. Because listen, like a couple things will happen. Actually, let me ask in the audience, is there anybody in the audience today that is planning to retire in the next 1 to 5 years? Anyone in the next 1 to 5 years? Just put, just put me. Okay, so we got Terrace is retiring in 1 to 5 years. Okay, so we got a whole bunch of people. All right, so this is wonderful. So we got a whole bunch of people that are retiring in the next 1 to 5 years. I got to ask, what is your biggest fear about retirement in 1 to 5 years? What is your biggest fear? Just put it up there, anything. Second time, Tim? Well, hey, listen, if at first you don't succeed, try again, I suppose. Money? Paying for medical insurance, love it. Not enough money, having enough money, running out of money, monthly bills, which is money. Okay, perfect. So the problem is, as it usually is, money, right? All right, wonderful. All right, I got to find something here. I'm looking for it, and I'm going to find it here. But if money's the problem, the biggest thing we need to be aware of is if you're retiring in 1 to 5 years. So I'm going to speak to all of those folks that said they're planning to retire 1 to 5 years. But I'm speaking to every one of you because we got 123 people on here. So I'm speaking to all 120 plus people, but I'm really talking to those of you in 1 to 5 years. I want to go a couple screens ahead here, and I want to talk about the reality of the situation we're in. If this is the stock market, okay, and then I'm just going to kind of draw this. So X marks the spot of where we're at. Anything here, so we'll say this is 2022 straight up to here. It kind of looks like a straight line up, right? The stock market kind of went straight up. And, we're still kind of just playing around here and we're, hopping around, blah, blah, blah. But if we're right here, we're off of the highs a little bit. So let me just paint a picture of the future. Now, you don't have to believe that I'm going to be right here, and it doesn't matter. And I'm probably not going to be specifically right in terms of when this is going to happen, but I definitely can tell you I'm going to nail it as to how this thing's going to play out. I just can't tell you when. Okay, so what's going to happen is sometime in the near future after, so I'm just going to draw a little line, and this line represents 2024. Specifically, I'm going to write the month of November 2024. What happens in November? Can anyone tell me what happens in November? Well, the shenanigans stops. Well, for the most part should, right? What happens right, it's an election year. So have any of you lived through other elections? Silly question, I know you have. But think about that. All your election years that you've lived through, were things a bit wonky the year of election? Wasn't it? Weren't things just a bit off? Like things just didn't make sense, right? Well, if you pay attention like I have to the markets and to money and to all finance, what never makes sense in an election year is how the stock market performs. It makes no sense, which actually makes perfect sense because it's manipulated. That's all you need to know. So all this run up of the market, so much of it has to do with manipulation. Okay, I'm just going to write man. Okay, that's manipulation. Also has to do with speculation. Okay, so manipulation, speculation, and I'm going to write one more thing, and this is the most powerful thing in investing, and that is human emotion. So does everybody understand how these three fit in with one another? Because I'm going to make the markets make a ton of sense, even if you have no idea what stocks, mutual funds, ETFs are, and if you have no idea which ones you own, and if you have no idea what they even do. Great, doesn't matter. But we understand what manipulation is, right? If someone manipulates you, they're basically they're not being truthful. They're trying to get an outcome for themselves that benefits them. Manipulation. I mean, we could look up the definition of it, but you all understand manipulation. Do you understand speculation? It's just like it sounds. You're speculating for a specific outcome. So manipulation and speculation really can play one, they're basically two peas in a pod, if you will. Well, I can tell you in almost every election year, there's manipulation and speculation. And right now, more than I've ever seen before in any other market cycle, I see this. And I see this because it is definitely going to be a very controversial election. You got two candidates, just like the last time. I mean, that worked out well, right? You got Trump and you got the dude, Biden. And then you got Kennedy, which is kind of a cool little dynamic, right? Because that's a very unique dynamic. But because of that, you've got polarizing hate on both sides. And you've got a lot of interesting things that most people would say, some would call them conspiracy theories. But here's what you also have. You have an economy that has run its course. You have an economy that is coming off of the worst hangover you could ever see an economy come off of. Like the economy went on a bender. I mean, come on, think back to your college years and just try to remember that one night that you don't remember, right? That is what the economy is doing. The economy had one hell of a party. Maybe had a little too much to drink, a lot too much to drink, blacked out for a little bit, woke back up, and has been just kind of stumbling around trying to figure out like who the economy is. That's where we're at. It's a $5.2 trillion hangover. And just if you want to put things into perspective, that's an awful lot of beer, an awful lot of old fashions, or whatever your drink of choice is. $5.2 trillion would buy a lot. And it did. It bought a lot of this. Markets going up because a lot of people bought goods and services. Like there's just so many things all put into this. But the hangover is wearing off because now we're starting to remember what we did when we blacked out or when we were in that drunken stupor. The economy is starting to remember these things, and it actually is starting to show up in future outlooks of companies. When companies are reporting earnings, they're reporting earnings during that blackout period, but then they're starting to say, well, yeah, but looking forward, man, I don't think it's going to be like that. So earning outlooks are going way down. So therefore, if X marks the spot, here is what will happen after that. We will go into a period of time where this will happen. I don't know when, okay? Is it Q1? Is it Q2? I don't know, but this is 2025. We are definitely going to see this because there is no other outcome that can happen. And I'm going to show you in a little bit with numbers, the inverted yield curve, which has been going on for quite some time now, which has never been wrong. I'm going to just show you a lot of different facts, but basically we can all agree that this is what's going to happen. So let me ask all of the folks that are retiring in 1 to 5 years, if you retired next year and this happened, would that be good for your finances? Not at all. If you retired here in 2026, would that be good for your retirement? No, not at all. But, let's just say here, we'll take it down here, but then let's pick it back up and let's call this 2027. Okay. And it starts coming back. That would be good for your retirement. But this would not be good. If for some reason you retired anywhere in this period of time and you started taking distributions from your retirement, you're out of money before you even know it. Because you're taking money from a portfolio that is declining and you'll never recover from that. But let's just forget about this because all of you, we can't go into the future and all of you could sit there and debate me on whether or not that's going to happen. So let's just come back up to where we're at right now. It's not hard to understand that the stock market, the growth we're seeing is so heavily manipulated. And you can see that a lot of different ways. Number one, you can see that in the Mag 7, the Magnificent Seven. 7 stocks keeping the entire S&P 500 propped up. 7. What are those 7 stocks in? Mostly technology, mostly AI. So AI, does anyone really fully understand AI? Some would say yes, some would say no, but I can say AI is going to be around for a while, but like the speculation, going to this, the speculation of AI is unknown. It is literally just saying, oh, I think it's going to be huge, so let's invest in it and let's value it really high, but we really don't know. All I'm saying is if you're retiring anytime in the near future, you better be really freaking concerned. But here's the best part. It's like climbing a mountain, right? What's the best part about climbing a mountain? Isn't it when you get to the top and you're looking around, you're like, oh my God, I just did it. You just climbed the mountain, folks. You did it. You made it. But what must happen when you're at the top of the mountain? What must happen? You have to come back down. Does everybody know that for the people that climb Mount Everest, more of them die on the way down than they do the way up? And it's heavily swayed to the way down. So we don't really want to ride or go back down from the mountain. So here's what you can do. I'll give you a phone number, okay? And a helicopter, once you get to the top, will come and pick you up. Great, okay? So now all you got to do is you just get on the helicopter. It's going to just fly over and you're going to get picked up and you're going to be super happy because you know that people die on the way down. So the helicopter just grabs you from the top. How many of you want to take the helicopter? Put helicopter. How many of you want a helicopter to pick you up after you climbed the entire mountain and now you spend some time up there looking around just being like, this is beautiful. Anyone want the helicopter? Okay. Does anyone want to walk all the way back down? Anyone? Do you know what the helicopter is? Who can tell me what the helicopter is? Who can tell me what the helicopter is? You should already know this. The helicopter is sell high. Sell high. That's your helicopter. If you've got a 401k, an IRA, you got a 457, you got a 403b, whatever. You got any of these. You got a SEP, fully invested in the markets. It's been a hell of a ride up. And congratulations. You are literally sitting at the top of the world right now, which represents the highest point the markets have ever been. Ever. Like you just climbed the biggest mountain in history. But you got to now manage the expectations of what's next. So I gave you the option for the helicopter. Okay. And that number is 800 sell. 1-800-sell now 1. Something like that. Anyway, I'm kidding. So that's it. That's your helicopter. And if you do that, you are going to have a really, really good chance of locking in profits. Because the only way to make money in the markets is buy low, sell high, and don't lose money. But let's come over here and let's talk about the different options. And here's what I'm going to do is I'm going to paint the picture of where money can go after you sell. Because once you sell, the money's got to go somewhere. So I'm going to give you some really, really unique places money can go. And this is timely because we are not only sitting at the highest point in the market, but we are sitting at some of the highest interest rates we have seen in 23 years. 23 years. Anyone on here less than 23 years old? I mean, that would be kind of neat, right? It's been 23 years. We're at the highest interest rates we've ever had. So if you sell from your 401k, your IRAs, or your SEP, you get out at the highest point. But let's not just talk about that. Let's talk about why did you get into the 401k? Why did you get into the 401k? Well, I'll tell you my story. My grandma. My grandma sat me down. I don't remember how old I was, 16, 17. And she said, Chris, when you start looking for a career and you start looking at jobs, what I want you to do is I want you to ask them if they have a 401k. I'm like, okay, Graham, kind of not really knowing what a 401k is. I knew it was a retirement, but I didn't know what the numbers meant. And she said, and if they say yes, ask them if they match. And I'm like, match? What does that mean, Graham? Well, she's like, it's free money. If you put money into that 401k, they just give you free money. I'm like, well, I want free money, Grandma. Right? So does anyone else have a grandma that told them, like, you just get free money in the form of a match? So the biggest reason people put money into 401ks is because of the match. And another nice thing about 401ks is the government is so kind that this year, 401k, 457, 403b, they let you put $23,000 in. If you're over 50, you get a catch-up on top of that. But 23 grand is a lot of money, fully tax deductible. So I'll write TD, tax deductible. Great, right? Everybody got really excited about those until you got the sign-up sheet, which had all these mutual funds that you needed to pick. And what do most people do now? Let me tell you, as an advisor, it was much harder in my early years, but in the later years, all we did is we said, hey, listen, we've got these retirement date funds or these freedom funds. And all you do is you just pick the year you want to retire, 2030, 2035, 2040, you just pick the date and we do the rest for you. How many of you are in target date or retirement date funds like that? Put I in the chat. Mohammed's like, oh my God, that's me. Right. You hit the easy button. So these retirement and freedom date funds are literally just like that Staples commercial where it's the easy button. You didn't want to know, you really didn't want to think about it. They made a strong proposition as to why you should do the easy button. I'll give it some color here. And it was because, hey, the closer you get to retirement, the more the portfolio moves to a conservative. So if the whole market falls off, like I just showed you, you're good, right? Not really. Not really. They don't work quite as good as they show. I can prove it. But the other thing, too, that you failed to ask is, okay, these easy button funds, what are the fees? Mohammed, did you ask about the fees when you went into those? Because they're more than double the cost of a regular fund in most 401ks, more than double. The average cost on these freedom date, retirement date funds is about 1.5%, but nobody asks that because the easy button is so compelling and the match button is so compelling and the deductibility button is so compelling that we fail to actually ask questions that matter. And that is the fees on these. Okay? So that's 401ks. Let's come over here to SEPs. If any of you are self-employed, maybe you've got a closely held company that's just you and maybe a spouse, you and a couple people, a SEP might make sense because this is it's a pension. These are defined contribution plans, 401ks, 457s, 403bs, IRAs, defined contribution, which means you define your contribution to it. Now, most people, if there's a match, let's just say 3%. Actually, here, let me give you the safe harbor match, 4%. Don't worry about what safe harbor means, but let's just say your match is 4%. How much are you going to put into your 401k if they're matching you 4%? Anyone want to take a stab at that? They give you 4%. Grandma said that was free money. And I can put any amount in because it's a defined contribution. So I can define the contribution. That's right. 4% would make sense. Let me just ask another question. For all of you that are putting money in your 401k, for all of you that have a match, are you putting in only up to the match? Or how many of you, let me ask it this way. How many of you are putting in more than the match like I did? Put more in the chat. So if your match is whatever it is, 4, how many of you are putting in more than the match? All right, a little more. Okay. Doug said more. Leonard said more. Why? Why? That's my only question. Why? Well, for me, because I didn't know. I just was like, hey, more is better. But more isn't better because 59 and a half is a long time away, especially when I was 23 when I started in Wall Street. 23 to 59 and a half, that's a long time, which means I gave up control of that money for that many years. And if I wanted the money out early for an opportunity, I'd have to pay a 10% penalty because God knows my 401k options are very limited. And today they're even more limited than I've ever seen because today they're made up of mostly freedom date funds or target date funds. So this is what people do. But if you're self-employed and you got a closely held company, guess what you can do? You can do a simplified employee pension, and they'll let you save $69,000 a year, which, hey, this makes a lot of sense and works for a lot of businesses because their CPA, people like Jimmy would look at this and they would say, hey, we can do a SEP. We can put that much in, get a tax deduction this year, which will help you a ton. So that's why the only word I wrote is deductions because there is no match. But you get the deduction. The only downside, and this is actually not a downside, it's a plus, but a lot of people look at it as a downside. Your employees, so let's just say you got a couple employees, based on the amount you put in, guess what you got to do? You got to share. Some of that money that you're going to contribute, you're going to have to give them a pro rata percentage based on your percentage you're putting away, and it's all weighted, but you're going to have to share some of that deduction. How many of you would do that? How many of you would have zero problem sharing money from your company with your employees just so you can get a tax deduction? Because like, that's it. We'll give you up to $69,000, but you got to share with your employees. You might only have to put a little bit in for your employees to get a big benefit, but a lot of companies will not do that because like, I don't want to give my employees anything. And that's exactly why your employees leave your company. That's exactly why your employees aren't happy. Like sharing and giving is a huge thing, but a lot of companies don't want to do that. And then there's IRAs. Easy. We can put $7,000 before catch-up into them. If you do a self-directed IRA, which is no different than a regular IRA, you actually have control of the money. You can, in a self-directed IRA custodian like Horizon Trust, you can direct that $7,000 anywhere you want. You don't have to rely on target date funds or just a limited basket of mutual funds or maybe one or two ETFs, which I've seen recently. You have the universe of investments that you can invest in. Literally, the only thing you can't do in a self-directed IRA is self-deal. You can't buy your primary house or lend money from your self-directed IRA to buy your primary house. That's self-dealing. You can't use your IRA money to buy your personal cars. Makes sense, right? You just can't self-deal, and you can look up the definition of that. But other than that, the self-directed IRA out of the bunch here is definitely the best because it gives you full control. 401ks, very limited control. SEPs, very limited control. IRAs, depending. I mean, very little options in some and a lot of options in other. But if we just add self-directed to any of these, so self-directed here, self-directed, you can do self-directed 401k. You can do a self-directed SEP. And I'm probably confusing some of you because you're like, wait, I want control, Chris. I want to be able to invest in anything. I want to be able to invest in a real estate deal. I want to be able to loan money on Private Money Club. I want to do all those things, but I can't do those in my 401k. I can't do those in my SEP. Sure you can. Sure you can. The rules are very simple. You can invest in anything you want. The IRS doesn't tell you you can invest in this and not that, outside of self-dealing. The custodian, the brokerage, the place where your money's held. If your money's at Fidelity, guess what they want you to buy? Can anyone actually, let me ask the audience. If your money's at Fidelity, you got a 401k, an IRA, or a SEP at Fidelity, what are they going to want you to buy or invest in? Can anyone tell me? That's right, Fidelity funds. And how about Vanguard? If you have and Vanguard is viewed as a highly reputable company, and they built their entire company, and they're massive now. They control so much. Vanguard built their entire company on low fees. But if you invest in a Vanguard IRA, what can you mostly invest in? Vanguard funds. You see how they're controlling you? See how they're manipulating you? See how they're driving you to just do what they want you to do? Now, Schwab opens the universe up and things like that, but I'm just simply trying to say sometimes you just need to lean into control way better. Now, I went a little too deep down that rabbit hole, but like Mohammed might have got something out of that. Some of you might have got something. I'm just trying to get you to start thinking about what's really going on out there and why things are the way they are and why most people don't even ask questions. But then when I pose the reason, some people are like, oh my God, I never thought about that. Like Mohammed was like, oh my God, I'm in those. But you never really gave it a thought, did you? But now maybe you do. So now let's talk about what I mentioned, the helicopter ride. Because I know all of you want a helicopter ride, and that's fine because they're giving them away for free. And all you need to do is sell. So whatever funds you're in, I'd always suggest going to the highest risk ones first. Let's look at some safe options. So I'm going to kind of just use, I'll do it from here. So right now is a unique time. And I'm going to talk to all of you about some things. And that video I was talking about, that engineer, and a lot of people right now are being led down a path that maybe they don't fully understand. And I know it's probably none of you. You're all the 5%. You're all pretty educated. But let's just talk real quick. I mean, when you guys have money at a bank, okay, maybe it's a high yield savings account. Actually, real quick, let me ask, how many of you have money in a high yield savings account? Just put yes, but put the interest rate you're getting. I just want to see how much Gina's got it in a high yield savings, 4.3%, Mohammed, good job. Okay, 5.3, okay, Norma's got 5.3, 5.4, Amanda's the winner now. Oh my God, anyone got anything better than 5.4? 4%, 5%, whoa, look at these rates, holy smokes. Come on, keep it coming, keep it going. Hold on, Will, hold on, pump the brakes real quick. I'm trying to build an audience here, so let's not go right to the conclusion. Because Will's like, hey man, screw all those rates. I'm doing better than that. That's all right. Gotcha. Anyone doing better than 5.4? So high yield savings. So 5.4 is the champ. Okay, 5.4. That's actually a really good rate. That's a really good rate. Congratulations to everybody that just talked about a high yield savings. And how you all feeling about that? Y'all feeling pretty good? Like Helen, Gina, let's see who else we got. Amanda, Lena, Norma, Mohammed. You're all feeling pretty good about those rates, aren't you? I see Mohammed knows where I'm going with this. He's like, not really. So far, okay, not particularly. Damn, I thought I had you. I was kind of building you up. I was manipulating every single one of you, and you didn't even know I was manipulating you. I was making you feel so good about the decision you made, and I thought I had you there, but I'm just not a good manipulator. Can anyone tell me why they're not excited? Like, I don't know, Gina, how come you're not really excited about that rate? Why? I mean, Mohammed, how come you're not excited about that rate? Because, I mean, just a few short years ago, you were getting nothing, 0, and now you're like 4 to 5.4%. It's still a crappy rate. Interruptible compounding, wow, smart. Not guaranteed. Hold on, I'm going to stop right there. Who said that? Lionel, not guaranteed. That's the answer I was looking for. I was manipulating you, trying to get you so excited about these higher rates, thinking I know we're coming out of a historically low interest rate cycle. Now we're in these high interest rates and you're getting these interest rates and you're so excited because now you're actually seeing your statement have interest, but you guys are too smart, way too smart. And then John pulled up a good point. He's like, yeah, but then I got to pay tax on that too. I get a 1099 at the end of the year after they pay me that crappy rate. But the most important thing to understand, the rates you're getting on your money markets, your savings, your high yield savings, it is short-lived. Maybe a little longer lived now. I guess Jerome Powell actually the other day prolonged that a little. So kudos to Powell. You know, they're going to keep rates higher a little bit longer. But we all know this is a very temporary period of time where we're going to get these kind of rates. And I think every one of you picked up on that. I think you all did. You all picked up on the fact that your rate you're getting at your savings account or your bank or your CD is a very temporary rate. So therefore, next year, there's a high probability your rate at your savings will be significantly lower, and there's not a thing you can do about it. Because there was nothing you could do about it when your credit card raised your interest rates. There was nothing you could do about it when your bank raised your line of credit, your home equity line of credit's rate. You could do nothing about that because you were not in control. Now, let me ask one final question, and I'm going to move back. For all of you that have those high yield savings accounts, how does the bank pay you that interest rate? Because that's pretty high, right? What is the bank doing to be able to pay you that interest rate? Who can tell me? What is the bank doing? Stay with me, Francis. Lending out money, yes, but not really. Hold on. Loaning out money. The banks are in the business of lending, but let's go to even simpler. Like the bank, if they're going to pay you 5, the bank has to make more than 5. So how are they going to do that on the front end? Yes, they're going to loan money out, but loaning money involves risk. So let's just keep things just very simple baseline. Okay, I love where you're going. Loaning money out, credit cards, charging more in interest, reinvesting your money. Okay, hold on. Henrietta, reinvesting your money where? Where? Definitely not the markets, folks. Definitely not the markets. I love what Deborah said. They're making a spread. And Henrietta said they're reinvesting your money. But to what? Virginia's like whole life insurance. Yes, but that's their tier 1 capital. Okay, I'm just going to give it to you. Okay, thank you. I finally got it. Bonds. Right here, bonds. They're reinvesting your money in treasury bonds or treasury bills. So if you go to a bank and you see a CD offer, and the average right now, you'd be surprised. The average, I just looked it up this morning, for a 1 month to 5-year CD is 3 to 4.95%, which I thought was pretty crappy. But if you buy a CD or you got a high yield savings, I'll tell you what the bank is doing. The bank is taking the money you give them, and the bank is going out and they are buying a very similar duration treasury bill or treasury bond. I mean, look at this. 1 to 3 month treasury bill pays 5.49%. So outside of this 5.4, but they're still making a spread. Let's go to the average, which was maybe 4.5. Okay, for those high yield savings, that was probably the average people were saying. So if the bank is paying you 4.5 and they're making 5.49, is that pretty cool? They're making a nice, that's a hell of a spread. It really is. It's a risk-free spread. The bank takes 0 risk in doing that. 0 risk. because they lock in, let's just say a 3-month T-bill at 5.49, they pay you 4.5. And if in 3 months they can't find another 3-month T-bill at that same rate, what do? Don't they just drop your interest rate? Oh, I know it was so good that you were getting 4.5, but now you're 4.2. They don't even send you a letter anymore. They just drop it. And you just have to find out by going on and be like, hey, wait a second. I thought I was getting 4.5 or 5.4. Now it's only 4. Like, what the hell? Well, what the hell is they can't find a T-bill to match what they're doing and make the spread that they want. 6-month T-bills, 5.38. 1-year T-bill, 5.18. 10-year, 4.67. So no matter what duration they're putting you in, they're matching it. They're basically making a spread by going out and doing what every single one of you can do yourself. Do you follow what I'm saying? You can do exactly what a bank does. You don't even need to be very smart to do it. But a lot of people, like, they're just not going to take the time and energy, which I'll have a solution for you by early 2025 for that. But let's get back to reality. So you could do the exact same thing as a bank, and the bank wouldn't make a spread. You can go out and buy a T-bill. It's very easy. Go to treasurydirect.gov. There's a whole menu. Just buy a T-bill, and you'll make the 5.4, not the bank. You know, so these rates are pretty damn good. And let's just say you had a bunch of money in a 401k or a SEP or an IRA, and you were saying, hey, I just sold, because this crazy guy, Chris, said sell high, take the helicopter. So I just sold and I need that money to go somewhere, but I need that money to be safe because I'm going to be retiring in the next 1 to 5 years. Great. Build a portfolio of T-bills. I mean, if you follow Ray Dalio, I think it's 55% is what he's suggesting in short, intermediate, and long-term treasuries. I mean, bonds. So you could literally ladder a portfolio of T-bills. You can just go on. You don't even need to be good at this, folks, because these bonds are guaranteed by the full faith and credit of the United States government. And also, if I can, real quick, this is a great time for me to interject with something very important, a word from our legal department. So if I may, as I'm going to start talking about T-bills and treasury bonds, I must read this. So here's my disclaimer. Any opinion expressed by me or my castmates is solely our own individual opinion and not investment or personal financial advice. This content is for informational purposes only, and this information should not be relied upon for investment or other financial decisions. Nothing contained in herein is financial, legal, or tax advice. Okay, great. There's the disclaimer. I don't need to read the second part because we're not bringing anyone else on, so there's no affiliate or anything like that. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. So that's out of the way. So now we can continue on. So, but let's just say you sold your investments in a 401k. You had a freedom date fund, and now you're like, maybe that's not the thing to do, and maybe I just want to sit on these gains for a while. Because listen, sitting at the top of Mount Everest is not such a bad thing. It's a beautiful view. So when you sell, you lock in your profits, and you're sitting at the top. So let me ask you this. This is a very simple question, so get ready. If you had made a bunch of money, and you sell, and you make 5% on that money, are you happy? Yes or no? You sell, you got all your profits, and you're making 5% of your money. Are you happy? Leanne said yes. Mohammed said yes. Keep going. Yes, yes, yes. All right. You guys are all too easy. Rick said not really, so I'm going to go back to Rick. But Stephen, I feel like we've done too good of a job of teaching them all because I'm trying to get a different response. I kind of like Rick's, not really. Most people would say not really, they're not happy with 5%. And Rick's been around the campfire for a little bit, so I'm going to discount Rick. And I know why he's not happy, because he knows he can just go on Private Money Club and make 12 to 15%. But you know, Will and Gina, how come you wouldn't be happy at 5%? Yeah, you're right. Good answer, Leanne. Well, yeah, Paul, 40% tax. Yeah, it's not enough. Okay, so let me just go with Gina. And Tim said, can do better. I like that. But let's just go with it's not enough. So essentially what they're saying is that 5% is not enough. I would then come back, and who said that? I think that was Gina, right? I would come back to Gina and said, compared to what? 5% is not enough compared to what? Because let me ask you this. If somebody actually did that, got on the helicopter, and let's just say they sold high, so they made whatever percentage they made on what they've already made by riding or climbing the mountain, but now they're out and they just go with a blended treasury bill and treasury bond portfolio making 5%, but it's not enough. But let's just say everything plays out like I said it was, and here's the market. It just goes all the way down, okay? 2024, 2025, 2026, going down. Your friends that you're talking to, you're out to dinner with them, and they tell you that they lost 30%. They literally lost 30% on those freedom target date funds that they invested in because their advisor didn't tell them maybe we should sell some of the winners and take those gains off the table. Now, Gina, if your friend lost 30 and you made 5, are you going to be like, yeah, I know markets suck, I'm only making 5%? Are you going to say that to your friends? Because compared to what? So your friends that lost 30%, would they be happy to make 5%? So just when you're looking at returns, I always want you to look at them in a standpoint of compared to what, okay? 5% is a great rate. Matter of fact, 5% is far above the distribution standard rate used in planning for retirement distributions. So when financial advisors come up with a distribution plan, I don't know where they're at today, but they will usually use a distribution plan of 3 to 4%. So if you're making 5, you're outpacing the distribution plan of 2%, you never run out of money. Because if you're only taking 3 to 4% out of your 401k, but you're making 5, and you're making 5 guaranteed by the full faith and credit of the United States government, you're not going to run out of money. But again, back to, so I just want to put that into perspective. Now we're going to turn this up a notch, okay? Compared to what? And also you do need to understand that T-bills, okay, especially the short-term ones, let's go here, okay? The 1 month to the 1 year T-bills, anywhere in duration, like those are short-term. So those aren't going to last long. So when the Fed drops interest rates, these drop with it, just like your savings will go down. So enjoy it now, just like your money markets will go down, and just like all CD rates will go down. But if you found a way to blend a portfolio of, 1 to 3 month, 6 month, 1 year, 10 year, 20 year, you just bought a bunch of them and you bulked up on the 10 and 20 years, which is exactly what I'm doing. Not giving you financial advice. This is exactly what I'm doing with my money, okay? My safe money, let me put it that way. So I am bulking up on 10 to 20 year treasury bonds. And it's not for the reason that you think. So here, what would that work out? Let's just do 4.7, okay? I'm just going to average this out at 4.7%. So just like Gina, I don't look at 4.7% and get excited and be like, oh man, I'm crushing it. But you know what I look at? The second component of buy low. So the reason I would buy 10, 20, 30 year, actually there's not 20 year bonds, but let's just go 10 and 30. You can blend them out and get 20 years. So 10 year and 30 year bonds, which are the two that I buy. The reason I buy them is not to make 4.7%. I'm not mad at the 4.7%. Matter of fact, I kind of like making 4.7 because that 4.7 at least keeps me somewhere about inflation, somewhere close to inflation. But the reason I buy these is I am buying them at one of the lowest prices they have been in 23 years. And that's very simple. And Mohammed, I think you'll like this. And I usually draw it on another screen. It's very simple. Here's an X. That's all it is. And I want to just draw 2 arrows. So a lot of times I do it like this, like Mr. 10X, he does it like this. But all I'm showing you is how bonds work. So let me draw a line through the middle. This is that 4.7% yield. This is and actually, I don't want to use big words, advisor words. So let's just call this interest. So my money's making 4.7% on those 10 and 30 year bonds. But here's when I bought them. So this right here is interest rates. I have been watching Jerome Powell raise interest rates over the last year and a little bit. And when he raises interest rates, I know number one, equities are going to go up, but I also know that treasury bond or all bond prices are going to go down. So out of all the times I've taught this to this audience, This is like really one of the only times where I can literally tell you like the charade's about to end. The tides are about to turn because prices really can't go down a whole lot more because we're literally not going to see interest rates go up any higher. I very much doubt Jerome Powell is going to raise interest rates any higher. So I can draw a line here. We have hit the maximum interest rates I think that Jerome Powell is going to hit. I don't think they're going to raise them higher. I think actually they're going to lower them. So I think interest rates will eventually in the future go down. And so just following this chart, if interest rates, when they go up, the price of bonds goes down, making today a really freaking good time to buy them because you can buy them low. If interest rates next year go down, and they're going to go down for a number of factors. Number one, we'll probably be in a recession, or the markets will be going off, or the economy will be weaker, or just because Jerome Powell's already said they're going to drop interest rates. So that's a pretty sure thing. So when interest rates go down, okay, these are interest rates. Can anyone tell me what will probably happen to prices? Simple, right? They'll go up. And that's why I buy long-term treasury bonds. So if any of you have a 401k, 403b, and you've sold, you've taken that, you've taken the helicopter, and now you need to know where to go, might I suggest treasury bonds? And might I suggest looking at longer term, and I don't want to say suggest because that sounds like I'm giving you financial advice. You might want to look at longer duration treasury bonds for that exact reason. Now, here's the reason people wouldn't. Gina said, what happens when the government defaults? We won't be alive. Okay, that's why. I don't think any of us will be here. I really don't. I don't think anyone on here is young enough. So that would be the least of your concern because, Gina, the government won't default because the Fed controls the printing press. So as you can see, if the government keeps going deeper and deeper in debt, they just keep borrowing more and more from the Fed. So they're not going to default. What they're actually going to do is different. They're going to deflate the value of the dollar. Actually, you've seen this happen. They're just going to keep printing money. They're just going to keep raising the deficit, and we're going to be the ones that suffer because our dollar is going to become weaker and weaker and weaker. Hopefully, we never, ever have to live through a period of time like the Germans did right after the war, when all they did is print money and devalued their currency. So hopefully that doesn't happen. But Gene, I wouldn't worry about the government defaulting. I truly wouldn't. Could it happen? Yes. Is it likely? Absolutely not. But basically, what I'm trying to explain is this is your safe haven. This is your safe haven for your money. You're going to be paid. I already showed you how much. Okay, you're going to be paid an interest rate on that money. You're going to be buying it low because treasury bonds are low. You're going to be backed by the full faith and credit of the United States government. But here's the other cool part. Here's the reason people don't buy 10 and 30-year bonds. They're afraid that they're locked in for 10 or 30 years, which is absolutely not the case. Treasury bonds are one of the most liquid investments that there are. There's not ever really going to be someone that doesn't want to buy your bonds. So you can easily offload them. So if the thing that I just showed you happened, and next year interest rates went down and the price of your bonds went up, and you're like, holy crap, sell high, which is what I'm going to do, you could just sell your bonds. You could just be done, get out, and you're out, and you make all the profits. And you did that with no risk. And you also did that when your friends are losing 20, 30, 40%, wherever the market goes. So again, it's all compared to what? If you're made 5 and they lost 20, 30, or 40, they would much rather be in your shoes. Follow where I'm going with that? All right. Clearly, I make absolutely no money giving you any of that, which is perfectly fine, but it's something you all need to understand. And I've got lots of other YouTube videos that go really deep into those treasury bonds and teaches you exactly how they work, all the ins and the outs. So if some of you are like, oh, keep going with that, I'm going to pause. Watch those videos that are specific to that, because now I want to kick this thing into high gear, and I want to bring all this together. I want to bring all this together to what I would consider probably the ultimate place and thing you could do with money, as long as you can handle a little bit of risk. Okay, there's going to be a little bit of risk here, but the risk you control, and you fully are in control of how much risk you take and how you protect yourself. Very different than buying Apple stock or Tesla stock or Nvidia stock. I don't know how all those are doing, but I know they're all off their highs. Okay, you can control this. So I don't care where the money comes from. Notice how I got a bunch of boxes. Savings accounts, money markets, treasury bills or bonds. We'll get to that one. home equity lines of credit, 401ks, just so you all know, you can take 50% or $50,000 from your 401k as a loan. And then you're going to get charged interest. So let's just say the interest rate today is 8% on your 401k loan. When you pay your 401k back, which you have to, that 8% is yours. You keep that. So it's really like a guaranteed return on your money. But anyway, here's what I want to try to get into is I want to try to get you to understand the alternative world. Now, the reason you need to understand the alternative world is simply because this is what the wealthy do with their money. Has been forever. This is what the banks do with their money. A bunch of you, when I asked you how banks pay you that interest rate, you said to loan money out. So my question for all of you, when I asked you, how do banks make money? You all said they lend money out. So then my question to you would be, if that's how banks make money, and they've been making money that way for hundreds of years, why aren't you doing the same darn thing? All right, it's a very logical question. Like, if banks are doing that, successfully doing that, why aren't you? And some people would say, because I don't know how. Well, it's not. What if I said, okay, great, but it would take you literally one day to learn the fundamentals of how to do it. And maybe you get a coach, maybe you hire Noah to teach you how to do it. I mean, there's lots of options, but like, if the banks are doing it and that's how they're making returns, like, you should learn how to do it. You should be the bank, just like we always talk. Well, that's what I want to teach you here. So I don't care where you take the money from, because I'm not going to get everybody to buy into the fact that the place you should be putting your money, your savings, is not a savings, a money market, T-bills and treasuries, like, yes, but I'm really talking about those for your retirement accounts. So I want to draw a line here. It's very important that now we're going to split it up. So we talked earlier about just retirement accounts. That's what I was trying to focus on, your retirement, your qualified retirement plans. Now I want to switch gears and I want to talk about non-qualified funds. So if you've got non-qualified money, money in a savings account, money in a money market, anything that's not in your retirement account, please consider that there is always a better place for your money to go. And this is what the wealthy figured out a long time ago. And that place is whole life insurance, but not just any whole life, because I'm not giving you the whole story. If it was just any whole life, well, everybody would be doing it, but it's not. It's a specially designed whole life. A specially designed whole life from a mutually owned insurance company that pays dividends. You don't want any of those publicly traded companies. You want big, secure, like, companies that have been around over 100 years, that have paid dividends for 100 years, that their names, they're all over, and you know them to be reputable, strong companies. But what you've then got to do is find someone like Steven, myself, or anyone on my team that knows how to design and engineer that whole life. So I'm just going to kind of put it over here a little bit, and I'm just going to put specially designed whole life, and I'm going to put a big X through regular whole life. Not that regular whole life doesn't work. I mean, it worked for all those wealthy families, but if we specially design it, what we can get is a lot more liquidity. Meaning we can put money into that specially designed whole life, and we can have a lot of that money available immediately in the first 30 days. How much of that money? I don't know. Normally I would say between 60 and as much as 90%, depending on how we build. Sometimes more, very rarely less. Okay, 60 to 90% of that money available immediately. Now, right there, most people would be like, yeah, but why would I do that? Why would I want to give up a percentage of money when I can use 100% of my savings? I can use 100% of my money market. I can use probably 100% of my T-bills, but I'm going to put it in a whole life and only be able to use 60 to 90%? Yep, absolutely. Why, you might ask? Because that doesn't sound like it makes any sense, right? Well, let's just say a whole life policy. You already heard the interest rates that all the rest are paying. Let's say a whole life policy right now. I'll just pick on one company. I'm going to get it wrong. I just looked the other day. I'm just going to round down. It was 5.8% because dividends have been going up. 5.8%. No one on here had a high yield savings paying 5.8%. But see, it gets even better. And I can't remember who it said this, but someone said, yeah, the bank is paying me 5.4, but I got to pay tax on that. This 5.8, which is interest, guaranteed interest, plus dividends, that grows tax-free if it's designed properly. So 5.8 tax-free is probably better than 6.5 taxed. But none of you are making 6.5 on your safe guaranteed money because the whole life policy is exactly that, guaranteed. The interest rate, guaranteed. Dividends are not, but the interest rate is. So already just from an interest rate and dividend standpoint and a tax standpoint, the whole life trumps any of those other things that I talked about. But that's not the reason to do it still. Some of you would be like, well, that's all I need. Okay, well, what would be the reason, Chris? Well, okay, well, if you have a family, there's a death benefit. So if you die, your family gets a big old tax-free payout. And some of you are like, that's great, but I don't have any children or anyone, so I don't care about the death benefit. Ah, darn, I thought I had you on that. Okay, so not caring about the death benefit, don't like your kids, don't like your wife or husband, so great. So why would you use the whole life? Well, how about this? Well, actually, let me frame it differently. If you had, let's just start with, let's do 50 grand today. We're gonna do 50 grand. And I'm gonna keep 50 grand because we already know we can only take 50 grand from the 401k. If you had 50 grand available in any one of these, you had 50 grand in a whole life, 50 in a savings, 50 in a money market, and we wanted to invest in real estate. Let's say you found a really good real estate deal. That real estate deal is going to pay you, I don't know, you're hoping with rents to make 14% interest. If all things go perfect, you'll make that. So 14%, which is better than what you're making on any of these. So you want to move money from savings, money markets, treasury bills, or the whole life over here to the real estate. How would that happen? Well, either a withdrawal or a loan. Okay, 401k would be a loan, HELOC would be a loan, whole life would be a loan. Savings, money markets would be a withdrawal. So you're going to take that. It's going to clear a bank account. Okay, because you're not going to even go from a savings to the real estate. You'd have to go from a savings to a checking account and then to the real estate. So all I'm doing is right here, the segregated account. It's just a checking account. So I don't want to complicate it, but it's always just going to be a stopping point. And then you're going to write a check, do an ACH, do a wire. Some banks might let you wire from a savings. I don't know. It doesn't matter. You're going to clear through this, and you're going to deploy the capital into the real estate deal. So let me ask everybody this. If I have 50 grand in a savings and I put 50 grand into a real estate deal, how much is left in the savings? 0. If I have 50 grand in a money market and I take a withdrawal and I put it into real estate, how much is left in the money market? 0. Treasury bills. If I have 50 grand in treasury bills and I move it into real estate, how much is left in treasury bills? 0. You had to take a withdrawal. Okay. The whole life, if I had 50 grand in the whole life and I took 50 grand, but I take it as a loan. So there's one downside. When I take a loan, there's interest. So let's just say 5% for now. Okay. So if I take the money from the whole life and I put it into the real estate, how much money is in the whole life? 50 grand. 50 grand, making 5.8%. Does everybody understand that? I'm now making money twice on the exact same dollar. I couldn't do that in a savings, couldn't do that in the money market, couldn't do that in treasury bills, definitely can't do that in a HELOC because I'm only making money once in a HELOC, but I'm actually making less using a HELOC because I got to pay the bank interest. Let's just call it 7%. So if I make 14 and I got to give the bank back 7, I still only made money once and it was diluted. I only got to make 7%. But that's not a bad option because if the money's locked up in your house in the 2x4s, that's a pretty darn cool thing to do. You're making a spread. Same thing with the 401k. If I send the money from the 401k over here, I got to make payments back to the 401k, although I keep the interest, which isn't bad. So I am actually now making money twice on the 401k. So the 401k loan would be a really good option. Just saying, because you're making money twice. You're making the money on the real estate and you're making money on the interest that you're paying the 401k back at. So that's not a bad option. I just want to keep things equal. But the whole life is the only one of the bunch that allows you to put money in, earn interest, and use that money to make money a second time. And our bleed rate, our cost of capital, is going to be lower for the whole life than it is for just about any other place you can take money. So forget about the death benefit. Forget about that the 5.8% grows tax-free. That is the reason you would use the whole life. But there's some rules. So I don't care if you invest in real estate. I don't care if you go on Private Money Club. I was just looking this morning. Let's just do this real quick because I got a second. Stephen, you got some other stuff too, don't you? Have you looked at any of the deals on here? Because here's the thing we're going to try to do as he's pulling this up, folks. We're just going to try to show you some other ways to make more. Because some of you were saying not enough money. I don't, retirement, what's the biggest fear? Not enough money, not enough money. Well, yeah, you're right. But not enough money also in a return also has to be paired up with less risk. So I'm always trying to get rid of risk as much as I can. And the best way I know to do that is to just copy a bank. How does a bank move money on a very low risk kind of baseline? So Stephen, what do we got here? Just talk through some of the stuff that we've got. This is, if any of you are wondering, this is called privatemoneyclub.com. It's totally free. You can go in, you can create a profile, you can look at all this stuff. If you want to become a premier member, great. That will give you additional benefits, additional listing ability. But what do we got here? We got some microloans.
Yeah, I know. Let's click this first one here. So it kind of depends on how much you have to lend and, good starting point. And then, so let's see here. So this is a 33% return, cash flow in 30 days, plus 6-month balloon, 75,000. So invest 75,000 and get a 33% return. Selective real estate in a general contractor that experiencing revitalizing homes in South Shore in Chicago near Lake Michigan. Money secured by a first lien mortgage on real estate. Fantastic return. This is for you. Selective real estate construction is a licensed and bonded general contractor that operates in the Chicago area. All right. So it looks like on this deal, they're looking for 75,000, receive 1150 a month, interest only, for 5 months, and then get 94,000 back on the 6th month. So it's 75 principal and 19,000 balloon. Limited time, only a few properties available. So there's one.
Not bad. First one we looked at. So anyone good with that kind of a return? It's not too shabby. And the only problem I see with that one, I like the return. I like that it's only 75 grand, but if I'm not mistaken, it's second mortgage. It's a second lien position. But up here it says first lien. So
yeah, I just want to clarify that this might have been like a template they used, but these are the real details. So it probably is a second lien.
Yeah. So you got to read these careful because at first it was first lien, but then at the bottom I saw second lien. So let's just assume at this kind of an interest rate, it's second lien, which means you're in second position, which means you hold additional risk that you would not have being in a first position. So let's see. What does this say?
It looks like a little flyer they put together.
Yeah, second lien. So that's the only thing I wouldn't do this deal simply because of second lien. I only want first lien position. So this would be a no-go for me, but that's okay. We're just trying to show you that like there's lots of first lien options on there. So I want to hit
real fast, Chris, real fast. While we're educating, let's talk about that real fast. So because there's a lot of people that are attracted to second lien position because it's often smaller amounts. So somebody that might only have $20,000, $30,000, that's available to deploy, on a private money club deal, they're not able to do the $150,000, $100,000 deals. If somebody's not willing to take, let's say 4 people at 25 each to do the 100,000. So in those cases, maybe a second position is all you can really do right now, but you still, 25,000 is still a lot of money, obviously. So you want to protect yourself. So if you are considering a second position, or maybe you just want higher returns. I mean, usually a lot of times second position, as Chris is saying, is higher risk. So higher returns, that's as investors, that's kind of how that works, right? The more risk, the more return. And so when we look at 33%, great, second position, maybe. So this is where you have to decide what kind of investor are you, what kind of risk tolerance do you have, and what does that look like? So for Chris, no second liens. I'd be open to look at it, but the only thing with second lien though is I would want to know a little bit more. So who is in first lien position? Just some things that I would think about off the top of my head. Who's in first lien position? How much is that lien for? What is that financing? Like, is it more private money? Is it a bank? Is it hard money? What are the terms of that first position lien? Like when does that have to be paid back? Things like that. So this is all stuff that I would take into account to make it realize, hey, is that second position worth it to me where my money would still be protected if worst case scenario happens or not? And then I'd want to look into the rules in Illinois and Chicago when it comes to second liens and how those are treated and what those can be done in the case of default. So, they're not necessarily bad depending on the type of investor you are. You just got to kind of know what you're doing. Is that fair to say, Chris? Would you say?
Very, very fair.
Yeah.
And it gave me a second to kind of pull something up because we got some great questions that came in. My personal preference for how I lend money is going to be very different than most of yours. And I also, to your point, Stephen, want to point out that I have lent money in second position. I right now have a loan to ROI Property Group, the Fullers, in second position, getting paid 18%. So I looked at the risks. I did the underwriting and looked at the deal and looked at the lenders, got a personal guarantee, which basically made me feel comfortable because I had a personal guarantee backing up a second lien position. I was good. And it's gone off perfectly. So just because I like prefer first doesn't mean you shouldn't look at seconds if it makes sense.
It's just pretty cool because you can see some of the smaller dollar amounts on some of the second position stuff. And remember, one of the cool things about Private Money Club, it's all truly private money, private individual investors, mostly with LLCs, things like that. So everything is a negotiation. It's all about asking the right questions. Well, first off, knowing the questions to ask and then how to ask those questions. Knowing how to position yourself during a negotiation. Chris, I've been, I know you talk about this a lot, but I've been listening to, I'm almost done with that book, Shoe Dog by Phil Knight, the Nike story.
Love it.
And, he talks about like when he asked when he got married, he asked his wife's mom, hey, before they got married, he wanted to take her out of town. So he goes to sit down and ask her, hey, can I bring her to this track event in Sacramento with me for the weekend? And she was like, no. And then he laughed and he came back the next day. She's like, no. And he's like, then he starts laying out like, but this and that. And maybe I make myself clear. And so he's safe. Like, now, do you mind if I bring her? And he's like, because of, you could tell she's never negotiated in her life. She just folded like that. And was just like, okay, you can do it. And so it just made me think like how important communication, negotiation really is. I mean, our good friend, Jamie Miller, who's going to be, is anybody on here going to Money Tank next week? If you're going to Money Tank next week, you're going to love it because Jamie Miller is going to be there. And he was on our 2-hour coaching. If you're a premier member on Private Money Club, we do a 2-hour coaching, which by the way, that is Thursday night, tomorrow night for this month. So get on there. But Jamie was on last month with us. Watch the recordings if you're a premier member. If you weren't on, he was with us in Orlando and he'll be us, but he's a master communicator. And when it comes to communication, that's what business is about, negotiation. So all of the stuff you see on Private Money Club, it's all a negotiation. So what you see on here, if it says 12%, but let's say it's a second position, you say, hey, listen, you guys need that 50,000. Yes. Well, I'm willing to lend it to you, but at 18%, well, it's going to tell you how bad they really need that money or not, because for an investor, I could tell you 6% on a short-term deal like that is not a big deal. So they're probably willing to do it. But if you didn't know what question to ask, what to look for, and how to say it, you're never going to get that. So if you want to simply make more money, learn how to communicate better. It's pretty easy. So let's see what else we can find on here, Chris.
Cool.
Was there any deals you saw that you wanted to pull?
No, not at all.
Okay. How about a bigger one? 575.
575 first lien. I like first lien. That looks like a nice property too.
Let's take a quick
6 bed, 7 bath. Is that going to be an Airbnb?
Posted 4 days ago. 6 bed, 7 bath rehab on 5 acres. How
What a
cool is
hell of
that?
a property. Look at that thing. Holy crap.
Ooh, I like that.
Yeah, look at that beast.
Thrilled.
That's what
Fred's
people
thrilled
want.
to
People
present.
want land, man. People want land.
So let's see. So Fred's thrilled to present an enticing investment opportunity. Let's see. Total asking price inclusive of rehab costs, $575,000. Presents an attractive investment opportunity with potential return, enticing return of 20%, offering monthly payments to investors. This venture promises lucrative returns. The current assessed value is $750 before rehab, and the ARV is substantially more. So on this deal, just like quick things off the top of your head, just, again, make sure it is a first position. At this amount, it probably is, but you'd want to break this down a lot more. So, and I don't see any documents down here. So we'd want to see like a scope of work, what we call a deal spec sheet, something around like what the perfect loan proposal is. And we could teach you all this stuff, through accelerator training, through the different coaching that's over, or through the different education over here as a premier member you get access to. But right here, I'd also want to say, okay, so 20%, is that an annual return? What's the length of this investment? If I give you the 575, when can I expect that back? I'm getting monthly payments. That's great. And then I want to see, okay, it's assessed at 750, ARV, which is after rehab or after repair, value substantially more, but how much more? What does that look like? What are the actual comps right now? How much work is involved? How much rehab costs? What's the time it's going to take? All of that stuff, as well as who is Fred? What's his experience? Does he have contractors? So some of the basics. but all very important stuff right there, Chris.
Hey, Stephen, one other thing I would be asking, I would ask, all those are great. I would ask Fred for a personal financial statement because I want to see what Fred looks like on paper. Because if, he's buying this property and that's inclusive of rehab costs, a couple of things I want to see is how much money does Fred have into the deal of his own money? Because I want some skin in the game and I want to see how much money Fred has. So can Fred make the payments to me? 20% is a lot. Is he going to be able to sustain those payments for an extended period of time? If he thinks he's going to finish the project in 6 months, I want to make sure he has a backup plan to pay me for 12 months because no plan ever seems to go on, on schedule. So I'd want to know how much of his own money he's got in, all the things Steven said, and I'd also want to see the contract for how much he paid for the property.
Absolutely.
But that right there, I'll tell you, that looks like a freaking great deal. I mean,
it looks to be in Colorado, which is
even better. Holy crap.
Yeah.
Property for $575 in Colorado. So, I mean, all right, like basically I don't want to, we could spend all day on Private Money Club just searching through deals, but all of you can just go to Private Money Club, create a profile and just go on and look yourselves. I mean, there's deals like this getting put up every single day. And, like when we were talking about rates, the reason we didn't get hung up too much on what's a good rate and a bad rate is this is what we consider just normal, which to everybody else in the Wall Street world, that's not normal. Like 12 to 15%. That's not a normal return. Wow, look at that one. Looking for short-term first lien position.
Anything else?
6-month fix and flip investment at 14%. Look at it's almost like it's like a really awesome buffet that you go to where you're just the only problem you have is your plate's not big enough, right? How many of you ever been to a really good buffet and you're just like, oh my God, this is all so good, and you start loading your plate, and the only thing that happens that's bad is you run out of room on the plate. And you can only really hold 2 plates, and that's tricky too, because then you can't load the 1 plate. So your plate is how much money you have to deploy. That's it. Wow, look at that one.
I like this too, 28 grand, perfect for a self-directed IRA because
Yeah.
it's a 5-year amortized at 13%. Just take, if you're, I'm 41 years old, I take my IRA, I buy that. I don't even think about it for the next 5 years. And I know my money's in there consistently growing predictably for the next 5 years at 13%.
So, I mean, and this guy's posted a lot of really good deals. So I do want to get to, a good question that Warren Scurry. Warren, you still with us? So let me just read what Warren said. And I want to, this is going to be really important because I always love it when people like Warren put this stuff up in there. I just want to make sure he's still with us because hopefully he didn't think I was going to dodge this question. He said, did I miss something? Okay, so let's look over here. I just want to put it into reference. Did I miss something? You have to pay back the whole life policy. Because remember, I did say you're taking a loan from the whole life, but you don't have to pay back the savings. So wouldn't that cost you less? This is a fantastic question. And it's a question that can only be solved by math. And that's the thing I love. Now, I'm not going to do the math on any particular thing. I've got examples that I'll show you in a second, but let me see. Warren, you still here, buddy? Yes, there he is. So what Warren's saying is if Warren took 50 grand from his savings account, even if Warren was making 5.4% in his savings, he knows that when he takes the money out, he's getting nothing, but he's taking a withdrawal. So he doesn't have to pay the savings back. So he just deploys it over here, takes the 14%, and actually, let me just do the math. I'm going to use 14% just as a number, folks. I'm not insinuating a return. It's just the number I put on the screen. So let's just roll with it, right? So 14%, so let's assume $583, okay? $583 a month. So what Warren could do, and what he's saying is he could take this 583, he could shift it back from the deal and back into his savings, and he doesn't lose anything. So he truly makes 14%. This is a 100% pass-through 14% return. But he's saying if I took the money from the whole life, and I did a loan and I got to pay 5 and I do the same investment, I'm not making 14 because I owe 5. So really I'm now taking 14 minus 5. I'm only netting out with the whole life. I'm netting 9%. So now let's just do the math. So Warren, what I'm doing is I'm just netting out the cost for the funds, right? I'm assuming 5, which is just an assumption, and I'm assuming 14. So if we got 50 grand times 9%, that's going to be $375. So who thinks Warren's right with this one? Because I mean, it's just math, right? He's making in the savings account, he's making 583. Yes, he didn't get, the bank didn't pay him, but he still made 583. But in the whole life, he only made, we'll do this down here, he only makes 375. So which one makes more money? Well, from the surface, looking at it, you would think that the savings account does, because you don't have to pay the 5% back. But let me share my screen here real quick. This is where math gets really complicated and just really kind of does a good job of solving it. So folks, I just want to preface, this is a brand new tool that Mr. Craig Yenny, I don't know if Craig's on here, every one of our clients from this point forward, actually from like 2 weeks forward, everybody that starts with the money multiplier BYOB starts the process. Once they complete their application and they do their medical, there's been no money exchanged. It's basically just I want to start a policy. Here's what I want to do it for. I worked with my money mentor. I've done my application. I did my medical. You will get your report just like this. Okay. So this is a real report that we do. It looks just like this. It will show you your compounded growth, your projected net benefits. It will lay out your policy, 60, here's premiums, guaranteed values, non-guaranteed values with dividends, and it will show you exactly this. So, but here's where math really does an awesome job. And this is why I love this. Yeah, Craig's here. So this is why I love Warren's question, because it allows us to kind of have fun with actual tools that Craig created here. So remember, every one of you on the screen, you just saw a second ago, I know you're seeing this wall of numbers, which I'll get to. The whole life, you're only making 375 netted for the 5 and 583 with the savings. So the savings from the surface, and like for most people, they would say, oh, the savings is going to make more because I don't owe. Well, what if, and this isn't going to be exact, okay, but just here would be the math we'd run if we were doing the same thing. We would input all the numbers into this calculator, into this tool. And this tool would assume every single assumption. It would assume how much is being put in. It would be assuming the loan taken out. And actually, this is, I might just get lucky, folks. This isn't planned. But see, I took a loan of $50,000, so I'm actually close. It was $50,026. So the loan interest would be $2,501 on this example. Okay, and then forget all this. Down here, this would be the investment. And Craig, maybe you know this better. Craig, what was the interest rate you assumed here? It couldn't, by pure luck, be 14%, is it? But anyway, it's probably not. So whatever the gain is that he assumed that he was lending on, it made 5,000. So he's got to give 2,500 back of the 5,003 that he made. So his monthly cash flow is 417. So this is very similar. I love it. It's very similar to what we're doing, except for there's the numbers Craig used. He used 5% loan interest, 10%. In Warren's example, I did 14. So we're very close. So just the numbers aren't going to be exact. So in the first year, Warren, if you put the money in the whole life, would you have made more than the savings? The answer is no, you would not. So you can see here, you actually would have had a cumulative investment loss of 3.19. So in first year, Warren, your savings account works better, okay? Second year, okay, same thing, except for now your yearly gain is 6,054, but you still only made 0.19. So year one and year two, Warren would be better off going with the savings account over the whole life. But you see, here's something unique. Something happens after that. Now, again, Warren, I need you and everybody else to understand that I'm only looking at a model here with 10%. So throw the 14% out the window. This is just 10 and 5. So once I get to the third, fourth, fifth year of doing this, and it took 3 years to get to this point. I had to give for 3 years to get to this point. But here's what you gotta really think. And Warren, this is how you make the decision from mathematics. Am I willing to make a little less for 3 years than I would if I just used my savings, so that from that point, 3 years on forward, I make more money every year for the rest of my life? That would be the question you'd have to ask. You'd have to say, am I willing to give up for 3 to make for the rest of my life? Because Warren is absolutely correct. You would make more in the savings in the early years. But as math will prove, from that 3-year point on, and do I have a tool? Here we go. Let me just get right down here. From that point on, from 3 years forward, the math absolutely favors the whole life and will every single time. And the only reason for this is uninterrupted compounding interest, because your whole life still pays you interest on the money. And every year that money's compounding on top of itself. So if you just consider the compounding effect, all things considered equal with the savings account, you're better off, because now here, not making 10 anymore. So now right here, year 4, okay, Warren, in this example, in the 4th year, you made 2% more than you would have in your savings. In the 5th year, you made 8% more, 8.6%. And then here it just runs away, 15% more. Okay, here you made 22% more. You see how this is, see what I'm doing here? These folks, this is pure math. Take all ideas or hype or conceptualization out of the equation, pure math. That's all this is. And every single year, yes, we are giving the insurance company their stupid freaking interest. And yes, every year we are giving them more interest because we keep using more and more money. As you can see, the number for the interest keeps going up. But one thing that you can't calculate in your mind, which is why Warren would have thought, savings is better than the whole life because of that loan. You don't and can't do the compounding interest in your head. It's got to be a calculator of some sorts. So here, what it does, this mathematically proves if you could give up 3 years, you will make for the rest of your life. And then the added bonus to this whole thing is if for some reason you ever passed away, from now until the day you die, there's going to be a death benefit. It starts at 1.5 million. The lowest point is probably 481. Yeah, 481. So is your family worth giving up a couple years of gains so that they're protected for your entire life should you ever go too early or go too late, which doesn't matter in a whole life. You can live too long or live too short, doesn't make a difference. But that's it. That's how you make the decision, folks. And I think these tools that Craig has created have literally changed the way we do freaking everything, because we no longer need to guess. We literally can prove everything. And then it just comes down to the client's decision of, am I willing to give up a little bit for a few years to gain for the rest of my life? And then you'd have to assume I'm going to live for a little bit longer than 3 years. And if you don't think you're going to live, you're still okay, because now you got the death benefit. Because here's the one thing, and I'll say this to everybody. Life insurance companies are not nonprofit companies, and you don't want them to be. They are for profit, and holy shit, do they profit. They make a lot of freaking money, which means we make a lot of money in a mutually owned insurance company because we get dividends. So you want them to profit. How do they profit? They charge a cost of insurance for that death benefit. So in the whole life, just make no two ways about it. There is a cost of insurance. You are giving the insurance company money, and it is coming out of your deposits. Okay? Not only that, when you borrow money from your policy, you are indeed paying the insurance company more money in interest. But the interest you're paying the insurance company is less than any bank or credit card or anything's going to charge you. But you have to then go to the math of compounding interest to make that decision. So hopefully that was helpful. That wasn't part of what I was going to talk about today, but I just thought, hey, listen, if we're going to get into this, let's get into it the right way. And I think that was a really great place for me to show that. So let me bring this thing home because we are over time. Was that helpful? Warren, was that helpful for you? We'll do that report we can do for every single client that starts with us. As long as they do the application and the medical, we'll do a customized report for them. It's the cost of doing business. Thank you, Dexter. That's all it is. So the one thing I did not explain, and I sort of got into it with this whole chart, is this flow of money. I don't care whether it's a savings, a money market, T-bills, whole life, HELOC, 401k. The one thing to make all of this work is whatever you invest in, whether it's real estate, promissory notes and mortgages of lending, multifamily, the income that comes back always should go back to the original source that it came from. If you borrowed money from a 401k, the money goes back to the 401k. If you borrow from a HELOC, the money goes back to the HELOC. The only money you keep is the spread. If you borrow from the whole life, the money goes back to the whole life. The whole life being the one weird one, because every dollar you put back in the whole life is money you have fully available to you. So, and the other one, savings, money market, those you understand. So the whole process of the infinite banking concept is what I just showed you without telling you that's what I was teaching you. And the final piece I want to talk about, and I'm going to wrap on this. The final piece to everything I just showed you is going back to those of you that are going to retire. If you decided not to take the helicopter and this happened and you were taking, your portfolio was losing and you were taking withdrawals to live, so you're afraid of running out of money. If you in your planning had a whole life policy specifically designed or specially designed, if the market fell and your portfolio, your 401k was going down, might I make a suggestion? Instead of taking money from your 401k that is already down in the dumps, don't. Stop the distributions from your 401k, and then let's set up a distribution plan from that whole life policy's cash value, and we'll just take the income needed to live from the whole life when the 401k is down. And then when the 401k pops back up, okay, when it comes back up and you're making money, stop taking distributions from the whole life and start taking distributions from the 401k again. By doing that, you have eliminated volatility risk in your 401k, because it doesn't matter if your 401k is up, down, or anything, because when it's down, you've got a side fund, that whole life fund, for you to basically take care of volatility, and they call this a volatility buffer. So that absolutely is something any of you doing retirement or planning for retirement, you need to have a volatility buffer, a little account. I suggest the whole life for the various reasons I just showed you, but if you don't do whole life, then just do a high yield savings, do a money market, do any of those things, a T-bill portfolio, a non-qualified bucket of money that then when the market is down allows you to take withdrawals without having to take money from a declining investment portfolio. Again, the whole life definitely mathematically makes the most sense. Was that helpful, folks? We kind of went off down a little bit of a rabbit hole there, but it was cool because that question was iconic. So it just made me rush at the end there. But just this is proper planning that all of you should be looking at. I don't care how you do it, just be the bank. If you do it from your HELOC, your 401k, your whole life, your bank accounts, just take money out, but redeploy that money back to the original source. And one final thing that I talked about, but I didn't really hit it hard, always use a segregated bank account for this so that you can do books and records on all of the flow of money. Do not have money go from savings to your black hole banking account that you pay all your grocery bills from, and then to your investments, and then from the investments back to the black hole, because guess what? It won't make it back to where it was supposed to go. But if you use a separate account solely for that purpose, then it will, because that's what it's designed to do. And it's so simple. In today's world, getting a separate bank account literally doesn't even require you going to the bank. Most of it can be done DocuSign. So any question? Let's hit some of the questions here, Stephen. Let's go to those, and then we'll kind of wrap up. And I know Anonymous was asking how to get started.
Oh, yeah. So if you want to start with any of this, I'll put a link over in the chat box. So just go right there and you can schedule a call with one of our money mentors. There's tons of availability. We make sure that we have that for you guys. And then on the screen, you can watch a 90-minute video. There's some other resources and stuff as well. So while you're waiting for the car, you can continue to get educated. And then Will Smith was saying, I haven't read all the guidelines for PMC, but it's real estate centric. Would it be an appropriate venue to pitch business startups, like offering equity stakes, startup investments, if this is already a thing? I just missed those listings. It discarded my question.
Yeah, so right now it is just real estate centric, or we've gotten approval from the attorneys to do things like equipment financing and different things, but we're keeping it real estate just because we're trying to be specific and be very niche in terms of what we do. You cannot put a business startup, you can't put a personal car on there, and that's really
we
just
can't have consumer loans. So we can't have consumer loans.
Thank
So
you.
anything like a credit card, like a car note, things like that. Now we have had people go on that are looking, so let me answer this. So the best way to do it is build relationships. You're never going to just post something and somebody's going to be like, yes. No, they're going to want to know you and who you are. So what I always recommend is post in the forum, hi, I have some businesses. I'm looking for partners. I'm looking for other like-minded people to connect with, to explore potential JV relationships and things like that. So as long as you stay kind of vague and it's more about the relationships, all is well in the world. Is that fair enough, Chris?
Yeah, very fair. Very fair. So Jimmy's question is a good one. He says, when you borrow from a 401k to fund a policy, you would have to pay back the policy as well as the 401k. Is that correct? Yes, exactly correct, Jimmy. Which is why you never hear us say borrow from your 401k to fund your whole life. I don't talk about that. I don't do that. There are rare occasions where that would make sense, Jimmy, and it would have to be a specific mathematical situation, like where we build the model using that tool that we just showed you to prove that it works. And in a scenario that it would work is like, let's just say you had deals on Private Money Club that you liked, taking a loan from the 401k, going to the whole life because you want the death benefit of the whole life, and then going to the deal. But you just have to understand you're going to make less cash flow because you are going to be supporting that 401k. In the long run, that would be a great strategy in the long run, but in the short run, it would suck because you're going to be burning all the cash that you're making in paying those two loans, okay, especially the 401k loan, because that's an amortized loan. So you really wouldn't make anything, but your 401k would benefit huge, and your whole life policy would benefit huge. So at the end of the day, you would certainly win. You would just have to understand what you're giving up for what you're getting. And you'd be giving up short-term cash flow in that scenario for sure.
Kind of back to what we were talking about earlier with the, using the policy to invest. You're explaining, paying back the insurance company. We do that for you also. So anybody starting policies, if you're looking to invest and grow your money, we can plug it into what we call the gain projector. So let's pull it up real quick. So this is a really cool new tool that we've created where we can take, so this is the policy right here. And then we can take details about whatever kind of investment that you're doing. So let's just say, I believe this one is calculated on a 12% annual return. And then the policy loan interest is paid from the gains. And then this one, we're not including taxes on the investment. So we have different ways we can adjust it and play with it. But this will actually show you in charts and through graphs and through these sheets exactly how your money's going to grow with the policy, for whatever types of investments that you're doing. So if you're scheduling a call with us, first off, if you have debt, let's get the debt paid off. And we'll create, a debt blaster for you for that. But if you're at the point where you're creating wealth, protecting wealth, creating a legacy, and you're investing, the gain projector is something we can, one of our tools that we can play around with to kind of show you exactly what that looks like.
And I know we're going a bit over, but I feel compelled to just share this real quick. I mean, this is just, I want to give you a snapshot of our new operating procedures. Obviously, the first most important thing is always going back to the Nelson Nash's becoming your own banker. Mr. R. Nelson Nash pioneered everything right here, the infinite banking process, because a lot of people think infinite banking is a whole life, people that don't know, but it is simple. We finance everything we buy with our banking system, not theirs. And we're either going to pay interest to someone else, which is borrowed money, or we're going to give up the ability to earn interest, which is paying cash, and there's no other way. So you don't want to give up the ability to earn interest, and you certainly don't want to give away interest. So the only way to do that is be the bank. And then here are the tools that we've been showing you, but now this is just going to give you just a kind of almost like a catalog of what you will get by starting with us and working with us. And I can say this with the utmost certainty. There's no other company in the infinite banking space that does anything even close to what we're doing. Not even close. They'll sell you a policy. They might say that they're going to design it perfectly for you, but they're not going to service it on the back end. They're not going to solve your problem like we are. We are investing heavily in you, and we're giving it all away for free. All we require is that you don't waste our time by not doing the application in the medical. So once you do the application, you sign it, and you do the medical, which means you got to have the nurse come out, a little blood draw, pee in a cup, and answer some medical questions. Then we will build a custom report, whether it's a debt blaster, gains projector, or major purchase planner. And that's basically going to show you how your money's in motion, just like I did in that example that I did there. And then this is always how it's going to look, the diagram. We're always going to show you like the policy, the loan, the segregated account, and we're going to show you this rinse and repeat process. And then we're going to also kind of always explain to you how the process works. It's simple. Premium dollars go in, that's your savings. Cash value is your bucket of savings that's growing with uninterrupted compounding interest. We're always going to take loans and pay those loans back because we're going to be an honest banker. If you die, the death benefit's there, but the death benefit also serves double duty, not just if you die, but it also serves as where your money comes from when you take loans. They're going to pull, instead of taking your cash, they're going to pull from your death benefit or from the insurance company's general account, like the big bucket. You're going to pull from the general account up to the amount of cash value, and they're going to subtract it from your death benefit. So when people say, I don't want to take a loan from my policy because I have to pay it back, it's actually not correct. you really don't ever have to pay the loan back. Although we don't teach it that way, you don't have to, because it just comes away from your death benefit. So this is all the stuff we've been working on, which, is deemed loan operations, and just showing you how everything works. I mean, literally, we mathematically prove every aspect. We always preach being an honest banker, but we show you the reasons to be an honest banker. And that reason is you will always, always make more money. Like, this stuff's phenomenal. I know it's a lot of numbers, and we'll walk through this with you on another webinar, but I'm so freaking excited about what Craig is building that I just had to put that out there. So one of the questions that came in, and I know, Stephen, you probably hit it, was, somebody has a Penn Mutual plan, which is a direct recognition company, meaning they recognize the loan, which makes it so it doesn't work as good as the ones that we use. But when people come to us with a direct recognition, or even just an off-the-shelf whole life policy, like not designed for anything, somebody just sold you a whole life, we really never, ever, ever tell you to replace them, because it's almost always not going to benefit you. And if it's not going to benefit you, why would you do that? So Muhammad, I think, asked that question. If you've got Penn, even though they're direct recognition, do not get rid of that Penn policy. Please don't get rid of it. Just use it differently. Maybe make the payments back to it a little bit higher velocity, so you're refilling the bucket. A direct recognition will work really well for infinite banking. Matter of fact, it will work phenomenally for infinite banking. Just don't forget to be an honest banker. Hopefully.
Yeah, just to add to that, and that's what I said in the response too, Chris. But just to add to that, and Ethan mentioned it over in the comments, you can change the servicing agent. And one thing that we can do with you is, if you do start a new policy with us, we do have our ongoing, what we call our implementation team, that can work with you to use the policies and take loans and kind of bring it all together. They're going to soon be using all these new tools that we have and everything like that. So one of the things we can do is we can switch the servicing of your Penn policy over to us. And then now we can incorporate that existing Penn policy, with your whole banking system. So that's something we can do with you, Muhammad.
Yeah. And also too, just, it's kind of, as he was saying that, just a little piece of advice. If any of you create a profile on Private Money Club, which I'm sure all of you will, because there's no reason not to, make sure you put a photo up. Put a photo up, because no one likes a faceless name. I've got a whole bunch of people right now in my pending, like they're trying to connect with me on Private Money Club so we can talk, but I won't friend them because they're faceless. So if you're putting a profile in Private Money Club, don't forget, add a photo of yourself, add a photo of your family, just put a face to the name, because I'm not going to friend you. I'm sure Steven's not going to friend you. And I feel bad. And I respond to these people and I tell them, put a photo up, like make sure you're not a faceless name. So if that's any of you, and I'm not going to call out any names, hopefully you take that advice and go in there and fix that sucker up and put your photo on there. But with that being said, Steven, anything else we should be putting in there?
I think that's about it for right now. We have, like I said, if you're attending Money Tank in any way, or you're a Premier Private Money Club member, our 2-hour coaching is this Thursday, tomorrow, from 6 to 8 p.m. Eastern. And then for the rest of you, we'll see you out in Salt Lake City, or virtually from Salt Lake City, next Friday and Saturday. What is that? The 26th and 27th. And it's going to be an awesome event. So hopefully you're there in person. I'm actually getting some text messages right now, like, hey, do we have any tickets left? Can I still get VIP? VIP sold out. There's a couple general admission tickets left, probably standing room only in the back, but at least you'll be there. And virtual, you can still buy. So we'll see you guys there.
Love it. All right, folks. Thanks for joining us today. Thanks for your time. I hope you learned something. I hope we got all your questions answered. But with that being said, if we didn't get your questions answered, join us this afternoon at 4:30 Eastern for the happy hour, Ask Me Anything happy hour, I should say. And you will then get to ask all the questions you want. So again, thanks, and we'll see you soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.